Good morning, good afternoon, good evening, whenever you happen to be listening to this week's I was gonna say episode, and I do say that because I need to get back to the podcast. That's the thing. For this week's video message. Now, we are a day off of when we normally get it. So, y'all, we are a day late in getting this to your mailbox, but we are not a dollar short. We are going to spend our time today talking about the 529 accounts. And so if you all are like, hey, where's that coming from? Who is she? Why is this lady so hyped? Did she drink some coffee? No, y'all, she tired. Why? Because this is my third time recording this video. I've been having technical difficulties. This is why y'all didn't get it on Wednesday, and this is why you're getting it today. But now the voice, the mic is on, everything is working, the video is connected, we can transition. This is what happens when you try to be your own production company, boo, and you trying to get it all together. And normally you have help. Y'all pray for your girl. I am none other than Patrice Elberry, aka the Tax Cop. Y'all, and this is real talk, real life, really happening. Yes, this disaster was really happening. But I told you all that we would spend time breaking down 529 and leading ourselves into the 529 trust. But I couldn't do that if I didn't take the time to really explain to y'all what 529 is, right? So today is going to be more a teaching video than what's going to happen next week, right? So I'm going to give you some highlights. Today I want to give you some history as to where 529 came from, what 529 is, what 529 is not. And y'all know the auditor in me won't stop, can't stop. It's probably not the best time to be doing that now that I think about it, since we are in the midst of the Diddy trial. Don't blame me. I keep telling y'all, I grew up, 90s was the background of my life. The hip hop R&B was bomb during the 90s. So, early 2000s, for the 2000s, that's what I'm going to give you every single time because that's what I know how to give. But today we're going to go and we're going to jump into this criteria. We are going to break this down so y'all can understand what a 529 isn't, what a 529 is, who can have it before we ever get to the trust. Because it doesn't make any sense for me to jump you all the way into the trust if you're not 100% certain as to what a 529 is, where it came from, where did it not come from, and what can it be used for, and who does it apply? Whom does it apply to and whom it does not? So we're going to go there first before we ever jump into, all right, now let me take you to a new strategy and take it up a bit as to how we can actually Rockefeller this joint. And yes, Rockefeller this joint is official accounting terminology over here at TTE. Before we Rockefeller this joint and figure out how we're going to get this a 529 trust to leverage it for future generations. All right, so first you got to get the history, then we got to build on it. So let's do the history lesson today. All right, so when you see this, and yes, it does say exempt organizations technical guide. So this is how people should operate. This is their technical guide and what things they need to consider. I'm going to use this, and this did come from the IRS, y'all. I'm not making this up. I just really want y'all to understand what's IRS, okay? What this is and what it's not. And this is really good. This is the most up-to-date revision as to understanding what is going on. But the thing was, the history and everything was in here. So that IRC section means Internal Revenue Code, Section 529. Y'all see how this coming together? Y'all see how this coming together? That's why when we're out here talking, we say 529 accounts and this, that, and the other. Really, it's based off of the section of the IRS code that this comes from. So I'm going to actually take you through the history of it. We're going to figure out what goes into it and what does not go into it. But in reality, all we're talking about is qualified tuition plans. That's what these are, okay? So let's look into it. All right, this technical guide discusses the requirements to establish and maintain a qualified tuition program under Internal Revenue Code, IRC, Section 529, also known as 529 accounts. So this is where we came from, right? So this is going to talk about everything that kind of falls into this category. I really wanted to bring to your attention what this is and what it doesn't. Where did this come from? How do we get them? So it's a tuition savings plan. We putting money out there, building our case, making sure the funds are reserved for the future so it could be used for education. All right. There's other things that fall into this category. in 520 section 529, we talk about the education credits. We talk about the Coverdale education savings accounts. You'll see those as your brokerage accounts, and achieving a better life experience, those able programs, right? So when people put money aside and let it grow in the because they're investing it, right, so that it will be won't be what they put into it, but it will actually go make money for them, so that when they're ready to go pay for education, be it private education, be it um, be it private school for high school, be it um, college, and it don't have to be a private college. Just when we're talking about leveraging these funds set aside specifically for education, this is what we're going to do. All right, so now college is a college savings plan, currently known as a qualified tuition program. People who are taking them out are going to receive a 1099Q, and I do have some clients that I work with that actually receive these. If they take they take the dollars out of the education account, they will be issued a 1099Q. And as long as those funds were used for educational expenses, right, then this will not be counted as income towards them, because they purpose this money, this after tax dollars, they purpose this money to be set aside to grow for educational purpose. Hopefully that makes sense. All right. So it was the first prepaid tuition plan was created in the state of Michigan in 1986. Go Michigan, right? They filed a suit so that it could happen. In 1996, so 10 years later, 1996, Section 529, as we know, we call them 529 accounts, was added to the Internal Revenue Code as part of the Small Business Job Protection Act. This provided tax exemption to qualify state programs and deferred tax on a participant's undistributed earnings. All right. So essentially, all that says is this: it says that you're gonna set away your pre-tax dollars, and when you go to actually withdraw those funds to use them for educational purpose, you're not gonna be taxed on them joints. We set that up in the code back in 1996 under the Small Business Job Protection Act. All right. And then the Economic Growth and Tax Relief Reconciliation Act of 2001 exempted the earnings of Section 529 from federal income tax as opposed to deferring the tax on undistributed earnings. So initially, we were deferring it like a traditional IRA, meaning that you put the money in, and when you pull the money out of the IRA, it was going to get taxed, right? So we're deferring the tax. But now, this is why I'm stating what happens actually now. In 2001, it was like, hey, no. So you're going to put the money in, it's going to grow. And when you take those funds out, as long as you use them for the intended purpose, we are not going to tax you on that on your federal. It's not going to happen. Why? Because you already paid tax on that money. Let's be real. You already paid taxing on this money. You're already doing this, and it's growing so that it can do what it needs to do. And any earnings that you pull from it, because that's the purpose we want. We want people to be educated. We want it to grow. We want you to leverage it. We want you to put it into these funds. When you use them for its intended purposes, then we're going to be good to go, and we're not going to tax you on that. All right? Then the Protecting Americans from Tax Hikes came under the PATH Act, which was in 2015. It had a special rule for a beneficiary of a 529 plan, usually a student who receives a refund of tuition or other qualified education expenses. This occurs when a student drops out mid-semester, and the beneficiary contributes the refund to any of his or her 529s within 60 days. The refund is tax-free. Y'all see, if you actually know what was going on in the code, they combine in a whole lot of things. So like when you actually take money out of an IRA, think of it this way. You take money out of an IRA and you want to give it to a new custodian, you got 60 days to do so. They did some of that same thing when it came to let's say the beneficiary of that 529 account, that child, that student, whomever, that spouse, say, yo, this probably ain't for me, but I done got a refund from the school. So guess what? That ain't your money. That money go back into the school because you're supposed to be getting educated. You're supposed to be using that money for its intended purposes. So as long as you give me that money back in 60 days, we cooking with grease. Don't be playing out here. All right? Then finally, we're going to look and see what else happened. The Tax Cut and Jobs Act of 2017 allows distributions from, and this is the most recent one that y'all are familiar with, allows distribution from 529 plans to be used to pay up to a total of $10,000 of tuition per beneficiary, regardless of the number of contributing plans each year at an elementary, a secondary, public, private, or religious school. It also allows a limited amount of funds to be rolled over from a designated beneficiary's 529 plan to an able account for the same beneficiary or a family member. Meaning, all right, so now this is where we start to looking, hey, what's going on, and start thinking wealth. All right, so let's say, I'm gonna give you an example. I have 4 children. Let's say child number 1 goes to school and does everything they supposed to and got everything out of their 529 account that they were supposed to, but there's some money left over. Based under the Tax Cut and Jobs Act, we can actually take them leftover funds and roll them over into either an able account for that beneficiary, meaning that they're going to have a good foundation to move forward with, right? Now there's something else that came out recently that it can go into a Roth, right? Or we can roll them funds into somebody else's 529 account. So it'll go to child number 2's 529 account because you ain't use all that money. And that person is a beneficiary on that, and it's going to be used for education. The other thing that was pointed out is, remember that now because of the Tax Cut and Jobs Act, because before it was only used for higher education. Before 2017, we were only using it for, people were using it for college. But now people are able to use these 529 accounts to get their kids into the schools they want. Hey, so because I want you to be competitive, I can actually use it in a elementary school, or when you go into middle school, or I can take you to a private high school, because you know what? I know I want you to, hey, I might have you go to public school from K through 8. But then when you get to high school, I know it's going to cost us a grip for me to get you into that private high school to get you to where I want you to go for college. Hey, I set up a 529 account for that. But let's say, what happens if child number 2 decides they don't want to go to college or have a traditional education route? What happens to those funds? Because I named that person as the beneficiary. Well, remember, you the one who set up that 529 account. You can name a brand new beneficiary. And when you name that brand new beneficiary, one of the beneficiaries can be another individual. It could be you. It could be a spouse. It could be a trust. Dun, dun, dun. It could be a trust. Let's put a pin in there and let's look and see what these things can be used for. Because that's the next thing that really matters. What can these be used for? Generally, a designated beneficiary is an individual. When enrollment in program starts and the individual is expected to receive amounts paid. Who can it be? It can be a member of the family. These are a spouse, a child, a brother, a sister, a father, almost like what you see on your dependency stuff. The spouse of an individual, a first cousin, right? It's supposed to be used for qualified higher education expenses, tuition, fees, books, supplies, equipment required for enrollment, computers, computer equipment, software associated with that computer equipment, okay? Internet access and related services. The term also includes certain room and board expenses in the case of a designated beneficiary attending at least half time. Room and board? What? So not just classes, room and board? That's what it can be used for. All right? Qualified elementary and secondary education expenses. Expenses for no more than $10,000 of the tuition of the school incurred by that beneficiary. And it must be eligible educational institution. What y'all are telling me is I can earmark my money to do what I want it to do when it comes to the realm of education, and I'm not 100% locked in. I can tell this money to go do what it needs to do for whom it needs to do. And because that pot of money is set aside for educational purposes, as long as I determine who the beneficiary is and it's used for qualified educational items, you mean to tell me that there's ways for me to actually leverage Section 529 of the tax code? There is. There truly is. And so, what we will do is, because this took us up to 2024, there have been a couple of different changes. Like I said, I added that because right now it talks about the able because this is February. But there's some other things that came around to it where funds could be transferred to a Roth for that individual, and or if we're talking about beneficiaries and one of those beneficiaries can be a trust, how we then perpetually continue to grow this and continually grow this and continually grow this for generation after generation after generation in our trust, so we actually have an educational fund specifically for not just now, but for the future. And so, what we'll talk about next week is that we will talk about the new changes, right, related to the Roth. And then we'll talk about, well, now that you told me what 529 is and I understand where it's going, how do I leverage it? Who gets to leverage it? Now, I'm going to tell you this. When I did my research, what it did say was 529 trusts are usually set up by the uber wealthy. I ain't gonna lie, I felt offended because I'm like, well, why just the uber wealthy? Is it because the uber wealthy are normally the only ones who normally set up trusts? Is it because we really don't understand what 529s happen to be? Is it because we weren't told what the rules are and that we could also do this and who could be the beneficiary? I actually believe it is the latter. That if you knew what the rules were and you knew what it took to actually sit down with an estate attorney, which I don't happen to be, okay, and actually establish a trust and set things up correctly, this would not just be something that the uber wealthy alone do. A lot of times what happens is we just don't know what we don't know. And so here's an opportunity for me to take a topic that somebody shared with me, and because I can't set them up, even though they say, tax professionals and stuff like that, I don't have a licensing behind, and I'm not an attorney. I didn't even set up my own trust. But now it's another aspect that you can earmark funds specifically for this as you are thinking about that wealth building plan and wealth building strategy as y'all move forward into actually using the code and the things that are in the code to actually be able to build that wealth forward. Because what did it already tell us? If we use the funds for what we need to use them for, it's going to grow and we're not going to pay tax on them earnings. Well, how soon can we start this? So what we'll talk about next week is, hey, what happens? How do we set up the trust? We'll use a couple of examples that I found, and we'll talk about practicality, and then I'll point you into the direction of some resources that you can look at to get down into this a little bit more nitty gritty for yourself, and or and then point you into some directions of some people that you need to talk to so that they can help you go set these things up so that you can actually do what it is you need to do the way you want to do as you're building things forward for you and your family. Until next week, peace, y'all.